Hi, welcome to your new Level Up series entitled Personal Residence. This episode is all about essential tax insight, our plans, and where we're headed. Just a quick recap. Last session, we talked about mortgage, credit certificate, and the necessary steps in acquiring that before deciding which property will finally be choosing as your next personal residence. And one of the key impact there is claiming mortgage interest deduction in your Schedule A as part of your individual income tax return or Form 1040. In this session, we'll be stepping back into what's really happening within that Schedule A and how does it affect our overall income tax return. Hence, we call this episode as the Essential Tax Insight. First, let's talk about the different concepts of standard deduction and itemized deduction. Technically, when filing U.S. federal income tax returns, you can choose between standard deduction and itemized deductions, which reduces your taxable income the most. Standard deduction, a fixed amount set by the IRS based on your filing status, single, married filing jointly, head of household. This option is simpler and doesn't require checking expenses. Meanwhile, itemized deductions, specific deductible expenses such as mortgage interest, state and local taxes, medical expenses, and charitable donations. This option is beneficial if your total itemized deductions exceed the standard deduction. Think of it like choosing between an all-you-can-eat buffet and ordering a la carte at a restaurant. For a buffet, similarly standard deduction, you pay a fixed price and get a variety of food without worrying about the individual costs. It's simple and works well for most people. For a la carte, similar to itemized deductions, you carefully pick each dish and only pay for what you order. If you choose expensive items that total more than the price, this option is better, but it requires more effort to track what you're getting. If your total a la carte bill or itemized deductions is higher than the buffet price or standard deduction, it's worth going a la carte. Otherwise, the buffet is a better deal. This way, you're deciding based on what saves you the most money. Now, so what are the things that you can actually claim as itemized deductions, if you have any? First is the medical and dental expenses. These are only deductible if they exceed 7.5% of your adjusted gross income. The state and local taxes include state, local income tax, sales tax, and property tax, but the total deduction is only limited to $10,000. Next is mortgage interest, deductible for interest up to $750,000 of mortgage debt for homes purchased after 2017. And charitable contributions, generally deductible up to 60% of your adjusted gross income for cash donations to qualified organizations. Non-cash donations or contributions have specific valuation rules. And you can also have other items like losses, investment interest expense, and other work-related expenses depending on your circumstance as a taxpayer. I suggest you consult with a seasoned professional to talk more about tax-saving opportunities. But again, if you don't have any of these items yet, the wiser choice would be standard deduction. Now we're somewhat oriented with what goes on with our Schedule A. Let's circle back once again to our current situation in the year of buying a home. There are items to look for, but the big question will always be what is deductible? Now, here's a list of items to look for in the year of buying a home. First, deductible in the year of purchase. What are added items added to basis? What are items not deductible and also not added to basis? First, items deductible in the year of purchase. These can reduce taxable income. You have there the mortgage interest, again deductible up to 750,000 if the loan is used to buy, build, or improve the home. Points or loan discount points deductible in full if paid to reduce interest on the loan with certain conditions. And also property taxes, again limited to $10,000. Next, items added to basis. These increase cost basis for when you sell the home, reducing taxable gain later. This includes purchase price, closing costs or certain fees. This includes title fees, recording fees, survey costs, legal fees. You also have there the home improvements or major improvements like adding a new room, roof replacement. These all include increased basis, while repairs do not. Impact fees, fees paid to local government for development or improvement of infrastructure. Lastly, items that are not deductible and not added to basis. These are personal expenses with no tax benefit. These includes homeowner's insurance, considered as a personal expense, not deductible. Mortgage insurance, used to be deductible but no longer deductible after 2021. You have there the homeowner association fees, not deductible unless for a rental property. You also have the utilities and moving costs, not deductible for a personal residence. Now, having said all that, keeping accurate records is very crucial, especially the year when you buy a home. We also have other recommendations like keeping all closing documents, track home related payments separately. You can categorize expenses like deductible, basis adjustments, and non deductible items. This will help you simplify tax filing. You can use a spreadsheet or an app. You can save the receipts for home improvements, keep detailed receipts, and save before after photos. You can work with a tax professional to check the eligible deductions and keep records for at least 3 to 7 years in case of an IRS audit. And home purchase records and basis related documents should be kept as long as you own the home plus 3 years after selling. So that's it for our episode, Essential Tax Insight. For part of our personal residence series, your plans to marry head. See you in the next one.